Welcome to the Summary Circle. The Intelligent Investor by Benjamin Graham is a seminal work in the field of value investing, providing readers with valuable insights and principles for successful investing. Published in 1949, the book continues to be highly regarded and has influenced generations of investors, including Warren Buffett. Here is a detailed summary of the key concepts covered in the book. 1. The difference between an investor and a speculator. Benjamin Graham distinguishes between an investor and a speculator. He defines an investor as someone who approaches the market with a long-term perspective, focuses on the underlying value of a company, and seeks to minimize risk. On the other hand, a speculator engages in short-term trading, often driven by market trends and speculation on price movements. Graham emphasizes the importance of rationality, discipline, and fundamental analysis for investors, while cautioning against the risks and potential pitfalls of speculative behavior. By understanding this distinction, individuals can adopt a prudent and intelligent approach to investing for long-term success. 2. The concept of Mr. Market. Graham introduces the analogy of Mr. Market to represent the stock market's emotional and fluctuating nature. He advises investors to approach Mr. Market with caution and make rational decisions based on thorough analysis, rather than being swayed by market sentiment. 3. Margin of safety. Graham emphasizes the importance of the margin of safety, which involves buying stocks at a significant discount to their intrinsic value. This provides a cushion against unforeseen events and reduces the risk of permanent loss. 4. Defensive and enterprising investing. Graham presents two approaches to investing. Defensive investors opt for a more conservative strategy, focusing on low-risk investments such as blue-chip stocks and bonds. Enterprising investors are more willing to take risks and actively seek out undervalued opportunities in the market. 5. Understanding market cycles. Graham emphasizes the importance of understanding market cycles. He advises investors to be aware of the impact of market fluctuations on stock prices and to take advantage of market downturns. Graham cautions against being swayed by short-term market trends and advises investors to focus on the long-term prospects and underlying value of a company. By recognizing that markets go through cycles of optimism and pessimism, investors can make informed decisions and take advantage of undervalued opportunities during periods of market downturns. Graham's approach encourages investors to adopt a patient and disciplined strategy that accounts for the cyclical nature of the market and aims for long-term success. 6. The importance of diversification. Benjamin Graham emphasizes the importance of diversification in an investment portfolio. He advises investors to spread their investments across different asset classes, industries, and geographic regions to reduce risk. Graham believes that diversification helps protect against the potential pitfalls of relying too heavily on any single investment. By diversifying, investors can mitigate the impact of individual stock volatility and unforeseen events that may negatively affect a particular industry or sector. Graham suggests that a well-diversified portfolio can help provide a more stable and consistent return over the long term, reducing the potential for significant losses and increasing the likelihood of achieving overall investment success. 7. Financial statement analysis. Graham provides detailed explanations of various financial ratios and indicators to help investors evaluate a company's financial health. Key ratios covered include the price, earnings ratio, earnings per share, and book value. Analyzing financial statements allows investors to assess the company's profitability, stability, and value. 8. The pitfalls of active trading. Benjamin Graham highlights the pitfalls of active trading. He cautions against excessive buying and selling of stocks based on short-term market fluctuations and urges investors to avoid speculative behavior. Graham argues that active trading often leads to higher costs, reduced returns, and increased risk. He emphasizes the importance of a disciplined and patient approach to investing, focusing on long-term fundamentals rather than trying to time the market. By avoiding the pitfalls of active trading and embracing a more rational and passive investment strategy, investors can increase their chances of achieving sustainable and satisfactory returns. 9. The psychology of investing. The author delves into the psychology of investing. He highlights the impact of emotions such as fear and greed on investment decisions. Graham warns against succumbing to market sentiment and advises investors to maintain discipline, objectivity, and a rational mindset. By overcoming emotional biases and making investment decisions based on thorough analysis, investors can avoid impulsive actions and increase their chances of long-term success. 10. Long-term investing. Graham emphasizes the value of long-term investing. He encourages investors to focus on the underlying value and prospects of a company over an extended period, rather than being swayed by short-term market fluctuations. Graham advises against attempting to time the market and encourages a patient and disciplined approach to investing. By maintaining a long-term perspective and aligning investments with one's financial goals, investors can potentially achieve satisfactory returns and build wealth over time. 11. Stock selection. Benjamin Graham dedicates a significant portion of the book to stock selection. He stresses the importance of conducting thorough analysis of a company's financial statements, competitive position, and management quality. Graham advises investors to seek stocks with strong fundamentals and sustainable competitive advantages. By focusing on companies with a margin of safety and buying stocks below their intrinsic value, investors increase their chances of long-term success and minimize the risk of permanent loss. 12. Bonds and fixed income securities. Graham discusses the role of bonds and fixed income securities in an investment portfolio. He explains their characteristics, risks, and the importance of considering their yields relative to prevailing interest rates. 13. Market indexes and mutual funds. Benjamin Graham highlights the benefits of index funds for broad market exposure, but advises caution due to limitations and fees. He encourages investors to carefully evaluate the expenses and performance of mutual funds before making investment decisions. 14. Value investing versus speculation. In The Intelligent Investor, Benjamin Graham explores the stark contrast between value investing and speculation. Value investing involves analyzing a company's fundamentals, assessing its intrinsic value, and purchasing its stock when it is trading below that value. This approach emphasizes a long-term perspective and aims to minimize risk by focusing on the underlying worth of a company. On the other hand, speculation involves making investment decisions based on short-term market trends, price fluctuations, and market sentiment. Graham warns against speculation, as it often lacks a solid foundation and exposes investors to significant risks. He advises investors to adopt the disciplined and rational approach of value investing to achieve sustainable and successful investment outcomes. In conclusion, The Intelligent Investor by Benjamin Graham serves as a timeless guide for investors, emphasizing the importance of value investing, rationality, and long-term thinking. The book provides valuable insights into stock selection, market cycles, and the psychology of investing, offering a solid foundation for achieving financial success. We trust that this guide will assist you in advancing your investment journey. If you enjoyed this video, kindly consider subscribing to our channel for more such interesting content. Thanks for watching.